Good morning, Mr. Steve Loukas. Welcome back to the podcast. Appreciate your time.
Good to be here. Thanks for the invite.
As a reminder to the listener, you're the CEO of Obsidian Energy, but to get a recap, what is Obsidian?
Yeah, sure. So Obsidian is a Calgary-based upstream producer. We really at this juncture now operate in two key areas. One would be our heavy oil business up in Peace River, and we have our light oil business in Wilson Green.
And for context, market cap's about $600 million as of today.
Correct.
And the business has had a lot of change lately, which we'll get to if that works for you.
Undoubtedly, yeah.
You're also working really hard these days, commuting from NYC weekly. In fact, you're taking a flight home after this interview, if I'm correct.
That is correct. Later this afternoon.
Can't say that you're not working hard for the shareholders.
Well, I'm certainly racking up my frequent flyer miles. So
taking commuting to a new level. I was also curious, maybe to go back to the days on when you found Obsidian. You guys were doing workouts and special situations and whatnot, but I was curious on how you stumbled upon the stock originally. What caught your eye on the company?
Yeah, so we've been invested in kind of varying intervals. Back when it was Penn West, and at the time there was underperforming. It was a vast portfolio, and we were looking at a bunch of the old income trusts, Enterplus, Penn West, et cetera. And, when we looked at some of the part, we also thought it looked certainly screen cheap. Now there's a difference between an attractive valuation and an attractive opportunity. And where the rubber meets the road typically is in the quality of the management team and the board. Penn West at the time was going through a bit of a board upheaval, and we felt that was ultimately a good thing. So invested, post that board overhaul, and liked the new CEO that they brought into time. And I think it's fair to say that kind of the events of November 2014, where you saw a bit of a price war ensue coming out of it. Created a dynamic where its balance sheet became stressed. Company traded in late 2015, early 2016 as if it were going bankrupt, and we made a call that it wasn't, that they had assets to sell, and increased the size of our position, and kind of that led to a sale of the company's Saskatchewan business to Tyne at a multiple that I think is fair to say surprised the market, and created another kind of managerial change, and so as we kind of continued to stay invested, kind of in varying degrees. I mean, the position size has changed over the years. There was a point in time where we simply did not agree with the direction that the new management team and board was taking it, and we ran a proxy contest, and it resulted in a settlement, which led to me joining the board along with Mike Faust. And we really kind of set, really embarked on, an exercise in trying to right-size the operations. At the time, you had a dynamic where the Redwater decision, was rendered, and, that created, a circumstance where, most companies that were below a certain size that had a fair amount of, kind of asset retirement obligations were placed into workouts, Obsidian being one of them. And, we helped kind of steer the ship through, kind of that dynamic. So, it's been a long journey. It's been, interesting, certainly a lot of twists and turns along the way. But, I think what, myself and the board take, kind of the most pride in is that, from where we sit today, we've worked through all of the legacy issues. We have the portfolio positioned exactly as we wanted. Part of that was the disposition earlier this year of our Pembina asset, which was a high quality asset, but I think it's fair to say that it was an asset that kind of Obsidian on a go-forward basis didn't necessarily need, and there's a variety of different reasons for that. So, like the position we're in, and happy to talk about it.
You're a hockey fan, I think, but did you catch the Jays game last night?
I did not catch the Jays game, although I was at dinner, and a number of the people at the table were locked in on the score. So I didn't watch it, but I was well aware of the score. And yeah, look, I'm not a Jays fan, but I'd say more importantly than that, I really don't like the Dodgers. So they are my adopted team, if you will, kind of in this series, and so certainly rooting for them to kind of bring it home and win it in Toronto. I'm sure it'll be one hell of a party to the extent that they can accomplish that.
So are you Yankees or Mets?
I'm a Mets fan.
Okay.
I don't dislike the Yankees, but I am a Mets fan.
Interesting. You got a lot of variety over in your part of the world. You got a lot of teams to choose from.
Yeah, I mean, you typically have two or maybe in some instances even three teams to choose from. So
yeah,
it's a nature of New York, right? It's not a one team town.
A little different than Canada, where we have one option in Toronto for baseball, anyways.
That's right. That's right.
So to maybe get a bit of an update on the company, starting with operations, if you want to go from there.
Yeah. So listen, I mean, this year has been kind of a little bit of an atypical year. As I kind of alluded to, we did announce the sale of our Pembina asset in February of this year. That was approximately 11,000, BOEs. And that transaction closed in early April. Very happy with the price. Very happy with the optionality that it created for the company, just given that, we were able to, significantly delever the balance sheet, into an environment where I think it's fair to say there's a little bit more uncertainty in the near term on price. We're also very happy with how it streamlined our ARO. A lot of the inactive ARO that resided within Obsidian was within the Pembina unit, just a function of it being an older field. And so, by extension, because it was an older field, it had higher OpEx. And so it certainly will lower, kind of OpEx kind of on a go forward basis. And so we've been able to redeploy some of those proceeds, firstly to paying down debt. Secondly, we've been able to be opportunistic and active on the buyback. And, we think we're buying shares back at material discounts to what we believe is intrinsic value. And it positions us to really step on the gas, on the production growth side, when we feel the pricing environment is constructive, to doing so. So, right here, right now, I think it's fair to say there's a lot of companies that are giving a lot of thought to their 26 budgets and, how much capital they want to spend in this environment. But, and, we're certainly in that boat and giving a lot of thought to that. But I think the more important takeaway is that we are in a position where, we can make the right choices for the right reasons versus, being painted into a corner and having market dynamics dictate choices on us.
So for the listener, the most recent disposition closed in the spring. The idea was to pay down debt, which I think you cut nearly in half. So that gives you flexibility and a bit of optionality just in case prices don't go the way we hope they do, in a nutshell.
Yeah, I mean, the way we look at it is maybe at the margin a little bit differently than how the market looks at it. I mean, the market tends to be, certainly the sell side analyst community tends to be myopically focused on, debt to EBITDA levels or debt to FFO levels. We look at it more through the lens of there's really three fixed charges that every company has, right? There's, interest expense to the extent that they have debt. There's cash taxes to the extent that they don't have tax pools to shield them. And there's your, kind of mandatory ARO spend. So from our vantage point, we're not a cash taxpayer. We have $2.1 billion of tax pools. And so, we would not be a taxpayer even at $70 WTI for the next 10 years or so at this current production profile. We've cut our go forward ARO expenditures by 2/3 as of 26 and beyond, just given that was a more ARO intensive asset. And we're in a position here in the near term to potentially refinance our debenture, our standing debenture, which, would also reduce our go forward interest expense. So when I look at some companies that in some instances may even be debt free, but are cash taxpayers, Our fixed charges are in line with some of those companies or even lower. So, we love the position we're in from a financial flexibility perspective. And, that was one of the key reasons as to why, selling Pembina at the value that we received, it was an easy decision to make.
You took shares in that deal with InPlay, and you've recently sold those shares too. So the deal has worked out.
Yeah, no, it worked out for all parties. And I think it's fair to say that that's, the ultimate definition of a good deal. It doesn't have to be zero sum. I think there's a tendency at times where, just the nature of negotiations turn it into a zero sum game. But, we knew that, InPlay was not going to be able to finance the deal absent, kind of our support and our willingness to basically, take back shares. We also had a high degree of confidence that we could monetize those shares, and we had potentially a couple, different ways out of the room. And so certainly a sale of our shares to a third party, was an option, but you never want to be reliant on only one option. And so, we specifically bargained for, the ability to offer those shares, at a discount to our shareholders, which is an exchange offer, which is very commonplace in the U.S. So I was a little surprised, to hear that it was actually the first time that such a transaction was, put forth in the Canadian marketplace. And we didn't see it through, right? Because along the way, notwithstanding we announced an exchange offer, we were in negotiations with Delek at that time, and ultimately they offered us a price that, was, we deemed to be fair to us, and ultimately transacted on that. So happy with the outcome. Same time, InPlay shares are trading well. So, it's good. I think it's good for the broader market to see a small cap deal be announced and be executed and have it trade well.
Mm-hmm. So who's Delek?
Delek is it's an Israeli holding company. They've got interest in the energy space, both on the upstream and the downstream side, and kind of both in the North Sea as well as in the United States, and they've also have a very large real estate footprint as well. So certainly an experienced investor, and they've been involved in energy in different forms for quite a length of time, and Canada was a market that they identified, and this was an opportunity that was brought to them, and ultimately decided that it fit with their corporate strategy.
So that would be your team reaching out to them? How did that deal work?
That would have been a banker reaching out to InPlay, and us ultimately agreeing to speak to Delek.
And Q3 came out today. The numbers are pretty strong, a little bit less production, but debt's down, and numbers were, I think you're happy?
Yeah, look, we're very happy, kind of with the numbers. As I said at the onset, this is a transition year for the company. We're starting to rebuild our production profile post having sold 11,000 BOEs in the Pembina disposition. Very strong results out of the Belly River, which we're excited about. We have a lot of potential inventory in that fairway. We announced an IP25, kind of at Crimson, which was approximately 535 BOEs a day, and so at a $5.4 million well cost, that's very, very attractive, and directionally consistent with returns that you would see out of the Duvernay. And the Duvernay is, I would say, a much larger play, but for a company of Obsidian size, kind of the inventory that we think that this unlocks is also, kind of sizable and, important in regards to how we think about the Wilson Green business on a go-forward basis.
Current drilling program. Where are the rigs running? And can you talk about a little bit of the early results? What are you seeing?
Yeah, so look, we're fairly locked into our, 2024 program. There's 2 months left, and, we're well hedged for the balance of this year, with approximately 70% of our production in Q4 hedged at Canadian $90, WTI. So, there's no real reason to deviate much. I think it's fair to say that, if we still own Pembina, we might be more inclined to slow it down. I do think that companies should not be tone deaf, and at the margin should be reactive to $60 or marginally sub $60 prices. But we're in a slightly different bucket, having kind of dispose of a fair amount of production. The program this year, you can almost think of it as a bit of a tale of two halves. Kind of if you think about the Q4 2024 CapEx program, the Q1 2025 CapEx program, it was definitely more delineation, exploration skewed. There's really two reasons for that. We've got a vast land base, and I think you want to be systematic in regards to how you think about trying to delineate it. And there's a seasonal component where in the winter you have access to if winter access in areas where you do not have all season roads, and so those tend to be late Q4, Q1 type of drills. Second half of the year was much more focused on where we felt we'd have a high confidence interval in regards to kind of operating results or drilling results, and that's why it's been much more skewed towards Dawson, as well as the Belly River, where we felt very good about what we thought those outcomes were likely to yield, and the results have been extremely good. We have commenced kind of a waterflood project at Dawson. We've got 2 injectors that started injecting 5 or 6 weeks ago. We're drilling 2 incremental injectors later in Q4, and then on the Blue Sky, we did have a conversion of an existing producer that was mature and had kind of low production rates, and we've converted that into an injector, and we've got a couple more of those on the docket for Q4. And so that really does 2 things, right? It starts to inject water and commence effectively a water flood project. It also allows us to reduce OpEx because we have a lot of trucked water in the Blue Sky, and we don't want to have to truck it to third-party disposal. So in any event, we're excited about that. We're excited about the Blue Sky and the ability to water flood it, and like the initial results. And I think we'll have a lot more to talk about kind of in the months to come.
You're seeing good results in the Peace River region. I think the production is around 13,000 barrels a day of oil as of September. And the well design, for anyone listening, has been a Wafa well design. What is that, and why is it going well?
Yeah. So look, Peace River it's a vast land base. It's a tricky play. There's clear water. There's Blue Sky. There's multiple sands. And it's really almost a collection of sub areas. Peace River kind of did hit kind of a high where it produced at approximately 15,000 BOEs a day, which are almost all oil for the better part of a week. It will average kind of well north of 13,000 for the second half of the year. It's kind of had a an inclining production rate, and so. One of the designs that the team has employed is effectively a waffle, kind of well design, and you can almost think of it as effectively a waffle type pattern. You create a waffle design, and the reason for that is it just allows. It's almost the analogy that we use internally. It's almost like a road network, a grid network. You can either have a bunch of roads that are kind of run parallel, or you can create a bit of a waffle design that creates release valves and just kind of allows for the oil to flow more preferentially. What we've seen is for incremental 7% increase in cost, we're seeing 15-20% uplift in rates, and so certainly warrants the increased cost, and we'll continue to selectively kind of roll it out where we feel it makes sense, and so it certainly has led to improved rates. And it's just a testament to the team and their creativity and their ability to continuously kind of improve the performance kind of within the field.
So are you kicking off underground to make the waffle? How does that process work?
Yeah, no, it's effectively there's the thing about multilats is an ability to you'd be surprised as to their ability to steer. And so, you've got your mother bore, and then you've got your kind of multilats, and then they'll just drill, kind of in a different direction and create the waffle design.
The idea is to get more oil.
The idea is to allow oil to flow more preferentially and not, potentially get bottlenecked, right? And so I think that's generally how to think about it.
And only in the Peace River?
Only in the blue sky to date, right? We're only drilling multilats in Peace River, and it's only in the blue sky that we've been, testing, and have rolled out a waffle design.
Are other companies doing this, or is it?
Not to our knowledge, right? But I think it's fair to say that, as a general comment, all companies are keeping track of what the others are doing. And so, would I be surprised if, someone else were to try it in the future? And I wouldn't. But I think it's also fair to say that there's only really 3 companies of consequence that are drilling in the blue sky, right? It's Obsidian, it's Baytex, and it's CNRL, right? And so, whereas, the Clearwater, tends to have, more in the way of operators. It's also has, kind of more in the way of, kind of junior companies that are more inclined to tinker, right? And so, but right here, right now, it's only in the blue sky.
Are you considering Waterflood? There's some companies getting really good results with that right now.
Yeah, no, as I alluded to, we commenced the Waterflood in Dawson. We've started to inject water in Harmon Valley South. We have a number of incremental projects in the blue sky on the water injection side. For later in Q4, we're drilling a couple incremental injectors in Dawson. We're giving a lot of thought to, kind of how much capital we commit to the Waterflood in 2026. The results that some of our peers, kind of have garnered are certainly not lost on us. I think it's fair to say, though, that as a general comment, Obsidian's probably been, the better part of 2 years behind on the primary side, relative to some of the Clearwater peers that, just got out ahead of it. And so by extension, we're only now getting to, kind of the water flood optionality that is inherent within our portfolio now. And so I think there'll be a lot more for us to say in the quarters to come. But look, we ultimately think it's going to work kind of in our fairway as well, and kind of within our portfolio. And it has meaningful implications on recovery factors. It has meaningful implications on OpEx to the extent that you can, kind of reinject your produced water. It has a meaningful, implication on decline rates, right? If you can successfully arrest your primary development declines. Now, there's, Tamarack has been actually seen, kind of inclining, kind of results. And so I think that's caught the market off guard. And when I say the market, not so much kind of our peers, but as much as I'm referring to the capital markets and investors, because specifically U.S. investors, I mean, they're less familiar with multilats to begin with, certainly less familiar with waterflood relative to, say Canadian investors, where water flooding kind of light oil fields is not a new concept, but, the concept of flooding heavy oil, 12, 13, 14, 15%, percent API oil, that, is a bit of a head scratcher for them. And for them to actually see
results,
inclining production, I mean, it's a almost too good to believe type of reaction. So everyone's watching it. And, we're certainly watching it as well. And, and I think there's, a fair amount of discussion, that's ongoing right now in regards to, injectivity rates and, water flood designs. And that's a good thing, right? It's a good thing. We're rooting for our peers, and we don't see it as zero sum.
Exactly.
Most of the land is spoken for in any event. So, we can certainly learn from others, and, in certain instances, they can learn from us. So we're excited.
Yeah. And so for the investors that may be listening, the reason waterflood's great is because it's a low spend and you get a lot of oil back. But maybe to get it from your perspective, why is the waterflood potentially a great option?
Yeah, I mean, listen, I think when it works, it's a very low F&D barrel, and you have the ability to significantly increase recovery factors, right? If you think about, cold flow, multilats, I mean, it tends to be a 3, 4, 5%, recovery factor, kind of business. Now with water floods, you can get it, 7 to 14%, right? So you start talking about, 2 to 4x, right? With polymer, where polymer may work in certain instances, you potentially get it, kind of, even higher than that, right? And so if you think about how you build sustainable businesses, it's, kind of low declines, high recovery factors, multiple payouts on wells, right? I mean, and that's what I think the market, kind of didn't fully appreciate if you go back even 3-4 years ago, right? Where, they were almost singly focused on IRRs and paybacks and less focused on, well, how much terminal value is created in a well, right? So you see some great, kind of wells or some great plays that they may spin your cash back at you in 9-10 months time, but the well may never pay out 2 times, right? And so, it's very hard to build a sustainable business if, those are the well characteristics, unless you have infinite inventory. But no one has infinite inventory, right? And so by extension, you have to start to give, real thought to decline rates and recovery factors, which is part of the reason why the market has now come full circle on thermal, right? If you go back, 5-7 years ago, kind of single asset thermal projects, I mean, they were kryptonite, right? Like no one really wanted them. That's part of what created the opportunity for Adam Wartress to kind of roll, kind of that space up and create Strathcona. And typically those assets traded at discounts to kind of light oil barrels. I mean, you go back to 2018, 2019, they basically traded at 50 cents on the dollar versus a light oil barrel. And you can look to where Athabasca traded. You can look to where those types of companies trade at the time, kind of, and just, validate, kind of that stat. Well, now they trade at premiums. Well, why do they trade at premiums? Because low declines, big recovery factors. And as an investor, as a public market investor, it kind of makes your life easier, right? Because you don't have to spend a lot of time thinking about the quality of a company's inventory and how much inventory depth they have. I mean, they have an oil sand project and you have a fairly good idea as to what you think, the reserve life is. And, you can kind of somewhat put your feet on the desk and, as long as they don't screw up the operations, it's just an easier business to invest in. So, it's just, if you're around long enough, you see things come full circle. And I think that's the point of the cycle we're in right now.
Yeah. Idea is you don't have to spend as much with, say, like the water flood to get more back in simple terms, in return on equity or however you want to phrase it, maybe.
Yeah, I mean, when it's working, you mitigate decline rates significantly. And so by extension, it elongates your primary development inventory and it increases your recovery factors from existing wells. So it makes the business much more efficient, kind of all around.
And it's not as risky. You're not out drilling brand new wells, although exploration can be great. In this case, it's kind of, where the oil is.
Yeah, I mean, where the oil is and you're just trying to increase recovery factors, which is a little bit different than trying to delineate, kind of a new play where, you think there's oil or you may know there's oil, but you just don't know whether, you can mobilize it, kind of at commercial rates, right? And so, generally speaking, the public markets right here, right now, they don't like the E in E&P. They really like just the P, right? The problem with that is eventually you've got to spend money on the delineation exploration, to ensure that you have enough inventory to continue to produce, or you trade at a multiple that's accretive and you just buy it, right? But either which way, you need to ensure that you're backfilling your inventory.
So looking ahead to 2026, between the Peace River and Williston Green, where are you planning to spend the capital?
Yeah, so look, I mean, 2026 is very much topic du jour, right? I think it's fair to say that, when we think about, kind of, what we're inclined to do next year, and when I talk to, some of my peers, I think everyone's trying to figure out, everyone's trying to figure out what everyone else is doing, right? No one wants to be an outlier. Everyone's trying to figure out, trajectory of commodity prices, and because clearly they have implications, kind of on what you spend and what you should do. I think it's fair to say that for Canadians, for Canadian companies, it tends to be a relatively easier decision. If you can think about, kind of a calendar year almost in 2 halves, kind of in the first half of the year, you really only make capital allocation decisions in Q1, right? Just because you've got breakup, which creates a natural, kind of intermission, if you will. So from where we sit, I don't think we'll do much different as long as prices are, kind of $60 or above. Sub 60, I think you want to be thoughtful about, kind of what you're doing and how you're doing it. And, we may kind of skew our capital program under that scenario more towards the second half of the year. We may, pull some of the waterflood spend into Q1 just because it's less sensitive to, kind of what the near-term price is, because in most instances it will take you multiple months to before you see a response in any event. And the NPV tends to be much longer in duration versus, the returns on a primary development well tend to be much more sensitive to the near-term price, when they on stream. And so, it's still fluid, and, I don't know that, kind of we need to make any final decisions, kind of at this juncture. I mean, the one advantage to, this company is that it's small enough that you can turn it on a dime, and respond to market conditions and market opportunities or risks. And at the same time, it's big enough and has enough scale that, under the right conditions, you can step on the gas and aggressively grow production as well. So we can be, tactical in regards to how we respond to the market.
Most of the production is coming from Willesden Green as of today, though.
It's actually more skewed at this juncture towards Peace River. If you think about our production, it's really, there's four components, right? There's our Peace River heavy oil. There's our Willesden Green. There's approximately 2,500 BOEs, which are in the Cardium, in Pembina, which are non-operated. Whitecap operates. That's our PCU11 unit. And then there's 1,100 BOEs or so in the Viking. So at this juncture, Peace River is, kind of your largest contributor on production. Although Willesden Green's probably as big, if not slightly bigger, on FFO because it's more light oil skewed, and it's a higher realized price.
How are you thinking about infrastructure with tie-ins, facility constraints, and getting production ramped up?
Yeah, so going back to the theme of this year, being a bit of a transition year, we have or are in the process of spending a little bit of capital on infrastructure. We're building an all-season road up to our Nampa field. We've drilled 2 wells in Nampa, and there's a significant amount of potential inventory, both blue sky and clear water, in that fairway. And so, we'd like to have all-season access. So we're in the process of building a road. There's 200 barrels a day or so of production that has basically been offline because, lack of all-season access. So, once we complete that road, which will be later in November, we'll be in a position to turn that production on. We think it gives us a lot of optionality and flexibility on a go-forward basis. We're really excited about Nampa and not just, the potential for very strong primary development returns, but, we think it might be one of the better areas to waterflood. And so we spent some capital on that. Down in Open Creek, we've got a debottlenecking project, just to tie into some of our, build out some gathering lines and tie into one of our existing gas plants. And so, that'll put us in a position where, we can, at our choosing, decide to aggressively grow our Belly River volumes and as well as our Cardium volumes in Open Creek, when prices are conducive to doing so. Open Creek is, it's a unit that we historically owned, only 2/3 of. And, as part of the deal that we did with InPlay, where we sold them Pembina, they owned almost the residual, percentage in the unit. And, we took that back as part of the consideration. So we now own 99.5% of the working interest in the unit. And, we're excited about some of the results that, we've had on the Cardium side. Very excited about the results that we hope to soon see kind of within the Belly River. We have a couple wells two wells that we will be bringing online here later in November that are kind of in that fairway. And so, we've put a little bit of capital in just to ensure that everything is debottlenecked, and we've got full flexibility when market conditions make sense to grow production.
It is. You try to de-risk, I guess, with infrastructure ownership. Besides the road, is there any other consideration on water handling, gas takeaway, or anything like that?
Not so much on gas takeaway. I mean, Peace River as a play is not gassy. It's 1-2% gas. We have all the gas plant capacity we need. So there's not much to do there on gas. Kind of on the water handling side, we have acquired a number of new disposal wells. So that coupled with, kind of some of the water flood pilots that we have, kind of on the docket for Q4 in Peace River will, kind of put us in a position where we're, where we need to be in regards to, handle kind of our produced water and significantly reduce, kind of both trucking costs as well as eliminate third-party disposal costs. I mean, it was a larger expense line item in the first half of the year than, we thought it would be. It's probably one or two kind of incremental small roads to be built in Peace River just to, kind of improve the access, the all-season access into certain parts of the field. I'm not sure that we necessarily need to do that in the first half of the year, or that's certainly capital that you can push out to the right if prices are low, and we don't think it's mission critical to do it in the near term.
From the gas side, it's been almost critical to own the infrastructure, or at least have reliable takeaway. But for the listener, maybe from an oil perspective, it's not as necessary. The oil prices haven't been tragically low. You don't have to own the infrastructure.
Yeah, well, you don't necessarily need to own any of your infrastructure as long as you have, kind of appropriate firm service and, at rates that are, market, and, you've got term to that contract. Now, the U.S. market tends to be different than the Canadian market. I think as a general comment, most U.S. upstream producers, they prefer not to own their infrastructure, and, that frees up capital to, drill or commit to drilling. That tends to be higher rates of return than owned infrastructure. Canada's a little bit different. There's more of an owned infrastructure mentality. And so by extension, most companies do own their plants, or, and so once again, just as a function of Obsidian being a larger, being historically part of a larger company in the way of PennWest, they do own a lot of their infrastructure, right? And so it really isn't, it's rarely a consideration for us. And, what tends to more happen is, do we want to spend a little bit of capital to debottleneck and increase kind of our handling capacity, or do we want to be thoughtful as to how we cadence kind of certain wells and on-stream certain wells? Or so it's situational specific, but it's very rare that infrastructure or the lack thereof has been a consideration on our end.
How about pipeline nominations? What are you seeing from that? And
yeah, it really hasn't been much of an issue. As a general comment, there's always month-to-month volatility.
For the listener, what's the difference between infrastructure, I guess, right around your wells, and pipeline nomination?
Yeah, so when you think about infrastructure that is kind of within the vicinity of your production, that tends to be more, kind of gas gathering lines. That tends to be oil batteries. That tends to be gas plants. And so it's all infrastructure that you need in order to produce and ultimately process your hydrocarbons. When you talk about nominations on pipelines, you're talking about, pipelines that, whether it's Enbridge or TransCanada owns, and, those are, pieces, material pieces of infrastructure, that, kind of larger companies typically have, kind of firm contracts with, and smaller companies tend to nominate on. And so, we have a robust marketing group that handles that, on a daily, weekly, monthly basis. And, I think it's fair to say that, kind of our forecasted production tends to be known within a, kind of a confidence interval. And, by extension, it's very, very rare that on the marketing side, we have, kind of, any real issue that bubbles up to me, right? I'm sure on a day-to-day basis, there's stuff that they deal with, but it really hasn't been an issue over the last 2 or so years.
Interesting.
Certainly in our neck of the woods, right? I mean, I think there's other fairways where it's a bigger consideration, but not when it comes to Williston Green or in the Peace River fairway.
From a capital allocation perspective, going into 2026, what are you budgeting between development, maintenance, infrastructure, return of capital? Maybe for the listener, if you can lay out high level.
Yeah, at a high level, I mean, listen, maintenance tends to be a given. The only time you really ever want to skip on maintenance is if the world looks like 2020 and it's about survival and and not necessarily just about say a more garden variety pullback in the price of crude. So maintenance is a given. We'll probably spend, I don't know, $15 million or so on maintenance. I think it's fair to say that at $60 you probably stay flat. Kind of not sure that it makes sense to grow in that environment. So directionally, I think that's how we would think about it. Now, what certainly is up for discussion is how we allocate capital within Peace River versus Williston Green. Under that scenario, how much we commit to the water flood. These are all discussions that are real time and fluid, and kind of are ongoing. In regards to infrastructure, I really don't see us spending much, if at all. Like, I think 2025 was the year where we spent some money on the Nampa Road and the Open Creek, kind of debottlenecking project. So there's really nothing on the horizon that I would say. If there's something we would do, it's maybe build another smaller road or two. But from where I sit, that's not something we would do in the first half of the year. It'd be more in the second half, and it'd probably be in response to kind of higher oil prices and us, getting ready to get back on our front foot. Look, on the capital allocation side, our shares continue to be cheap, and we've been aggressive with the NCIB. In fact, we fully completed kind of our NCIB during the third quarter. And so I think it's fair to say that kind of if our equity will continue to trade at these anywhere near these values, kind of once we're in a position to kind of launch a new NCIB, which is in very early March, I mean, I think we'd be active in that regard once again.
That implies that shares, from your perspective, are undervalued. To what degree do you think they're undervalued?
Yeah, I mean, listen, there's what people say and there's what people do, and we'll let our actions speak for ourselves, right? In the sense that, for themselves, I should say. We've aggressively bought back our shares, and at the same time, I think we've proven that we have an ability to execute kind of on deals, right? So it's not as if we have our blinders on and don't understand where the market is, and for assets of our nature, and so we think our shares are very cheap to intrinsic. I mean, I'm not going to give you a number because that's subject to different assumptions, different time horizons. But when I say they're cheap, I'm not saying they're 20% cheap, right? So they're materially more than that. If you use a mid-cycle price of, say, even $70 WTI, right? I think that's one of the mistakes. Maybe it's not a mistake, but it's just a dynamic. That kind of I've seen over the years between oil investors and natural gas investors. Kind of anytime there's a bad season in natural gas, and natural gas basically kind of trades down considerably, everyone looks past it, right? And says, that's not a normalized price, right? I mean, and we're going to look at it more on a mid-cycle basis. And that's why you've seen these equities, kind of trade, really, really well, notwithstanding that for the last 2 years, AECO, has generally been weak. Now, there's another reason for it. It's become a bit of a backdoor way to play AI and data center growth. And so, but you've generally seen natural gas names trade very well relative to kind of the near term kind of natural gas price. And obviously, what they're discounting is a higher mid-cycle price and beyond. And, for what it's worth, I agree with that, right? And And, we've been bearish on gas. And, over the last 2.5 or the better part of 3 years, we've actually had $42 million in natural gas kind of hedge gains, right? Notwithstanding we're not even a big natural gas producer. So, we have followed through on that view via, it being reflected in our hedge profile. For the first time, let's say I'm balanced on gas and, I'm not bearish, probably not bullish, absent a very cold winter, which, is kind of impossible to predict, right? But structurally, I am, bullish on gas. Oil, it's almost as if the market annuitizes, a low, near term price, right? And, doesn't really think through the dynamic that, and the U.S. producers have told you that. Yeah. You can read Diamondback's letter.
Case did the podcast.
Yeah, it just doesn't work, right? And so I don't even think that that's where OPEC Plus ultimately wants oil, regardless, right? And so their budgets certainly, are not geared towards it. And so, I think if you were to talk to most people and that are well versed on the industry and the cost structure of the industry and kind of the depth of U.S. tier one in the Permian, you structurally need a higher price, right? And so now that's not to suggest that it can't trade lower in the short term, and it very well can, right? But most people that are making capital allocation decisions, kind of tend to look at it more through a mid-cycle lens, and something with a 7 in front of it is kind of much more apropos than something with a high 5 or low 6. So looking at it through that lens, I think there's a number of companies that are cheap, and we're certainly one of them. I think that's part of the reason why, if you look at some of the more recent premiums that have been paid over the last year or so, Queetno earlier this week, was a 65% premium to the unaffected price, right, when they commenced the strategic review. You think about Crew, it was a massive premium that Tourmaline paid. You think about I3, which is a lower quality business than certainly Queetno or Crew, but once again, a big premium paid by Grand Tierra. So, what the market is telling you is that small cap names, specifically in Canada, they're just dislocated, right? And they trade at discounts, material discounts in many circumstances to their fair value.
Yeah, which people are recognizing, at least the ones who watch in this market.
Correct.
Dividends? You ever consider dividends?
Yeah, listen, dividends is something that, we would consider under the right circumstances. I mean, we don't think that right circumstance is right here, right now, but the company still has some growth in front of it. But, as we think about, kind of all the options, kind of that, kind of are on the table, both in the way of growth. And when I say growth, it's kind of a multi, kind of there's a number of different layers you can, kind of peel that onion back on. Is it growth in the Clearwater? Is it growth in the Blue Sky? Is it growth via primary? Is it growth via, kind of the Waterflood? Is it, Wilson Green? Like, we have a lot of levers to pull. But at some point, I think it's fair to say that it could also certainly make a lot of sense to start to, kind of pay a dividend. Right here, right now, we have, pursued a return, kind of capital strategy. It just happens to be through the buyback, right? We just think that's a better, that's a better decision at this juncture, just given the discount that we trade to intrinsic. Now, at some point down the line, buyback, is likely going to make a lot less sense, in part because, we view buybacks as an opportunity, not a strategy, right? Sure. And so if we execute kind of on showing the market the potential of kind of our land base, then valuation will, kind of start to reflect that, and buybacks become less attractive, and certainly dividends will be on the table under that scenario.
Now that you've paid off some debt, you've got breathing room, so to speak. The undervalued equities in the Canadian markets would suggest room for acquisition. Do you ever consider growth via M&A?
Look, what I would say, what I've said, and what I will reiterate is, we would not look at an acquisition that was outside of kind of a basin that we currently operate in. So, That really means Williston Green and Peace River. With that said, we have, and we'll look at everything that, potentially comes, kind of, for sale or becomes available. But there's two bars that, kind of, it needs to hurdle. Like, number one, we already have a lot of our own inventory. And so, is that something, is adding more to it something, that we want to do? And number two, you can buy back our shares, right, with minimal execution risk.
Yeah.
And so right here, right now, there isn't anything that, that has come across our desk in the last 12 to 18 months that has made sense. We've only done one deal, if you don't include the 45% working interest in Peace River that we bought in 21, which really wasn't a deal. It was more of a financial transaction because we already operated and, had a majority, interest in the asset. We did the Woodcut acquisition. That was small. That made sense at the time because it helped jumpstart our Clearwater production. We thought and continue to think that there's a lot of upside in Gift Lake, so that made sense. But it was by no means, it didn't stop us from doing anything else that we wanted to do because it was truly just a bolt-on. And so, we'll look at everything. The bar is high. And we really like, our asset base as it's configured. And, unlike some companies don't need an acquisition to backfill our inventory position, we can aggressively grow organically.
Yeah. Speaking of M&A, you've got pretty strong ties to the States. I mean, you're going there tonight. What are you seeing in terms of U.S. investor interest in Canadian equities, specifically in energy, as Tier 1 inventory maybe runs out? What do you hear?
And is your question on the public side or the private side?
Both. I mean, if you look north from stateside, what do people think these days?
Yeah, look, I think on the public side, I think most investors have gravitated to some of the names that they think there's likely to be M&A. MEG was one of those names where, U.S. investors would own or have, did own it prior to, Strathcona, coming out on it. It was, I think a consensus view at some point in the near term, it was likely to, to receive a bid, and in part because it already received a bid in the past, right? So you weren't blazing new trails. Companies like other companies in Montney, I think, are certainly on investors' kind of radar. I think there's generally a Montney consolidation trend or thesis that is fairly pervasive. I think that the only issue that you really have for public investors in the U.S. as relates to Canadian names is just market caps, right? I mean, in many instances, the market caps are not large enough, in order for them to be able to take sizable positions. I mean, even if you look at Tamarack, which we discussed earlier, great company, they've been doing a great job. But if you look at the market cap in a U.S. dollar context, it's a little bit over $2 billion, right? It's not that big where you can go put $100 million to work U.S. and not own 5% of the company and have your liquidity, kind of be, not as, just you own more of the company than you'd ideally like to. And that makes, kind of getting out of the position, if you so desire to, more challenging, right? So it's really market cap size, which I think is an impediment to seeing more U.S. dollars flow, up to Canada. As it relates to the private market, U.S. private equity has been extremely active in Canada.
Yeah, there was a fundraise like last month, a big one.
Yeah, so there was a fund that raised a $600 million kind of Canadian dedicated fund.
Who was that?
That was Carnelian, I believe.
Right.
You have obviously, kind of Queetno, which was announced this week, which was, NGP and Carlyle, kind of putting money to work. If you go a few months back and you think about the Vermilion disposition, that was another U.S. private equity firm. So, what you're seeing are really, two trends, right? One is U.S. PEs effectively, the small cap buyer of choice right here, right now. It's a function of the fact that it's very hard for Canadian small cap companies to raise equity. we've got a first-hand experience from the perspective that, we were involved in plays raise, and it was challenging for them, right? And it was more challenging than it should have been, in my opinion, for a strategic and accretive deal, which, the market has subsequently validated was a good deal. But at the time, it was a lot more challenging than I think anyone would have thought, and it only got done because we agreed to hold $85 million, right? And so, so it's USPE that's kind of stepped in to fill the void. The second dynamic is, I heard a stat of, which is about a month or so stale, but there are 28 U.S. private equity teams that have equity commitment lines of $300 million US or more. So there's just simply a lot of teams looking to deploy. There's a reason for that. I mean, the last vintage of funds, for the energy P on the energy P side were very good, 2.5, 2.7 times MOICs, and so that's allowed them to raise new funds, in many instances larger than the last funds. And it's typically what typically happens is when the return profiles have been good in the last vintage of funds, kind of there's too much money that's chasing historical returns, and there's just not enough opportunities. And so there's not enough opportunities in the U.S. A lot of the U.S. basins are also well consolidated, with strategics having materially lower costs of capital, such that USPE can't as easily compete for scale opportunities. So they're coming up to Canada, right? And so I think it's a trend that won't, I think it'll continue, right? I think you'll see them active in the Montney, in the Duvernay, and under the right circumstances in other basins as well.
Sometimes the producers are proxies for those PE firms, but do you see producers looking north for inventory?
I think it's a matter of time. I think, as a general comment, I mean, what scared off a lot of U.S. producers from coming north was the prior administration. They just didn't view, that administration as oil and gas friendly. I think, the Carney administration, to date, kind of has said a lot more of the right things. And, while, the proof is ultimately still in the pudding, they're saying the right things, and that's catalyzing strategics, kind of starting to give thought to, getting smarter on Canada, and so that's one dynamic. The second dynamic was there were deals that still needed to get done in the U.S., right? Before you exhausted, kind of the opportunity set and need to come north. So there's still probably a couple deals that need to get done and, ultimately will get done in the U.S. But I think as a general comment, I would not be surprised if you see a U.S. producer make a sizable, Montney acquisition in the next 12, 18 months.
Notwithstanding you guys, you came up to Canada in the depths of the previous federal government.
Well, I didn't come up by choice, right? I was on the board, and circumstances unfolded in a way where I needed to step in, and the world works in funny ways sometimes.
Cheap, good investment. People will chase regardless. Maybe you could say.
Yeah, no, I think that's fair.
So as you look towards 2026, we are about $60 oil nowadays. Without giving short-term oil predictions or anything like that, how are you viewing maybe U.S. inventory and that influencing oil markets for the next couple of years? Are you shale tier one inventory depleting? What do you think? How does that affect OPEC? And what's
I mean, I'd say a couple things. I'd say,
without getting too short-term,
U.S. oil inventories are a lot lower than a $6 price, would indicate. Like most instances across, kind of most products below the 5-year average, right? Even if you look at last, kind of the draw for last week, it was a lot larger than, kind of the estimates, kind of had forecasted. So, what you have a dynamic where OPEC made a decision to unwind, kind of, their withheld capacity. And, I think there's, plenty of debate, and we're in the process of finding out exactly what how much spare capacity they truly have, right? Because I think it's a consensus view that it's overstated, right? But the only way to disprove a negative is time, right? Which is, well, unwind it and let's just see who has it and who doesn't, who can produce, kind of at their quota versus, those who can't. And I would say to you that based off of kind of, I wouldn't say it's the work we've done, but certainly a lot of the work that, just as a function of talking to a lot of smart people. And I personally don't believe there's a lot more than 1.2, 1.3 million barrels that are kind of currently withheld, right? With Saudi having the bulk of that spare capacity. So it just will take time, for that to be unwound, for the market to truly, kind of appreciate that dynamic. And so this has always been a shoot first, kind of ask questions later type of commodity. It's a function of the fact that the financial market is so much bigger than the actual physical market. And so, but ultimately we think it's a positive, right? I mean, let's just kind of get it all unwound. And because I think part of what's kept the generalist investor, on the sidelines, it was this notion of, I don't want to get invested in oil-weighted names because at some point, OPEC brings their volumes back and I get the rug pull, right? I'd rather invest when it's all in the market and then I know that risk is no longer, kind of possible. And so we actually look at it as a positive. Like, let's just get all that, all that kind of withheld, production into the market, and let's see the real state of the union at that juncture. Regards to Permian Tier 1, because it's really the Permian, like that's really where the growth has come the last 10 years. I mean, Eagle Ford, Bakken are, kind of in decline. I think most people would tell you that have strong views that either side of 2030, 2031, you see, an exhaustion of Tier 1. There's some companies that have less than that, and there's a company like, someone like Diamondback has considerably more than that, right? But as a composite, as an average, it's somewhere in that zip code. And so, to the extent that you can, you own, kind of lower decline, a lot of resource in place, type of production, I think you're going to see a step function change in the price of oil. Does that come end of next year? Does it come early 27? I don't know, right? I mean, anyone who tells you that they know, is kind of, is probably doesn't. But I think it's fair to say that, we probably have some chop to work through here in the next, 1 to 3 quarters. I mean, this is a known, the fact that OPEC's unwinding is now known. It's consensus, and everyone's barrel counting and then trying to figure out when the market comes back into equilibrium. In my experience, this is less commodity specific, just more kind of broader market specific. Things don't tend to be as bad as you fear, and they're typically not as good as you hope, right? And so I don't personally, subscribe to we're going to have 4 million barrels of, excess, kind of production next year. And like, or put another way, I don't believe the IEA, right? Like, it just doesn't make any sense to me.
They've been wrong.
But it hasn't stopped them from, doubling and tripling down on their views.
Do you think the IEA influences big capital suppliers in New York to a considerable extent?
I think it did more a couple of years ago than it does today.
Because they look towards that.
Well, I just think it did. If you go back a couple of years ago, I think there was a greater concern about ESG. It was a more prevalent theme. That's now abated, in part because the returns were terrible. And so going back to the IEA, I mean, I think that they influenced the big kind of capital allocators more a couple of years ago. At the time, the ESG theme was more prevalent. That's since abated, in part because the returns, were not good, and ultimately capital flows to those who treat it the best. And then secondarily, I think there was just there was more of a prevailing fear that EV penetration rates were going to be materially higher than they are today. There was just more of a fear that oil was on its way of being phased out, and there were a lot more in the way of peak demand calls, kind of than certainly are today. And all those calls have been wrong, right? And kind of, one of the interesting trends is that, it's just how much power prices are up in the last 3-4 years, right? And it's becoming a more persistent complaint on the part of the consumer. But the importance of that is, I just think it makes EVs even less competitive. And so you haven't seen peak demand yet. And, now there's the relationship maybe change, with economic growth, probably it has to some degree, probably will continue to do so with efficiency gains, what have you. But, the most important takeaway is you have not yet seen peak demand. And, it's OPEC's view that, there's going to be an incremental call on, kind of OPEC volume sometime in the future. So at some point they'll start to invest in growth again.
Yeah, it seems like the narrative's changing a bit, like with Bill Gates' announcement 2 days ago that the ESG, I guess, era and the move away from human prosperity, all that stuff, it's just changing. And so it ties into the traditional energy and power demands, and all of that wraps up together and seems to be changing.
No, I think that's right. And, but with that said, I mean, I don't think oil-weighted names will work again, will truly work, until you see kind of stabilization in the commodity and you see it grind back into the mid-60s. But you typically want to buy these names when they're out of favor, not when they're in favor, right?
Yeah. A couple questions from X/Twitter.
Sure.
Hey, you got a lot of fans on X. So just to keep some fans happy, maybe we'll start with account titled Oil Money. Where does Steve see yourself in 5 years with regards to Obsidian? Do you view it as a long-term commitment, CEO, chairman, or what are your thoughts?
Yeah, listen, I don't know where I view myself in 5 years. I mean, if I was a betting man, I'd say, I certainly won't be CEO. I still like the public markets, and, to some degree, this role has kind of, not allowed me to spend the time that I normally would. But, with that said, I'm bullish on the opportunity, both kind of for the industry as well as at Obsidian specifically. And, until we kind of see the equity trading closer to fair value, I think it's fair to say that, I'll probably be here. And, as long as I'm having fun, and I've been having fun actually trying to build something, it's, as I said, earlier in the interview, I would not have bet that I'd be here. The world works in funny ways, but actually trying to build something has been rewarding.
Yep. Thoughts on credit markets for Obsidian doing a refinance in 2026?
Yeah, credit markets are extremely, constructive right now. You've seen, government of Canada yields, come off, kind of yields trade down significantly this year just because of the rate cuts, and at the same time, spreads have come in, significantly, just given that there's just a lot of capital looking for, fixed income returns. And so I think it's fair to say that, we're constantly, kind of in a process of evaluating and under the right conditions we'll look to pursue a refinancing.
Another account titled Nicholas James. The addition of the enhanced recovery to the Peace River heavy oil program has been good. And so as a result, how are you viewing the declines in the recoverable oil from this area? We already talked about it a little bit, but
yeah, I don't think we're looking at it much differently than, perhaps our peers are. I mean, I think as a general comment, recovery factors on primary tend to be 3 to 5%. We think we get them 6 to 14% just on water flooding, kind of where water flooding.
That's really good.
Yeah. I mean, and that's consistent with what you're hearing. And I think it's fair to say that as a general comment, we're confident that it's going to work kind of on our land base. I think it's fair to say that it will work in varying degrees depending on the sub area, but it certainly is a lever that we are literally only starting to pull, and we're excited about kind of the implications for decline rates. Excited about what it means for ultimate recovery factors. It's part of the reason as to why we've been as aggressive as we have been in buying back our shares. Right? I mean, there's a lot of resource in place. I mean, there's we calculate roughly 11 billion barrels, kind of in our fairway. So if you can recover 5% of that, it's a lot of oil, right? So, and these are numbers that are consistent with what, Tamarack and some of our other peers kind of, have outlined as well.
We already talked about it a little bit too, but Obsidian is expanding participation in the Bell River play around Williston Green. Any thoughts on this emerging play in general and your participation going forward?
Yeah, so we outlined our initial result kind of in Crimson, kind of this morning as part of our earnings release. That well has not yet hit IP30, but it's IP25. And, at this juncture, it's fairly indicative of, how it will perform. I think fair to say it's materially higher than, kind of our type curve. And it's the first well kind of in the Crimson fairway, and it unlocks a significant amount of inventory given that Obsidian effectively controls that fairway. It has material implications on Williston Green, because what it allows us to do, if we so choose to, is significantly grow production using existing infrastructure that kind of is in place because of our Cardium production. In many instances, I think you'll ultimately be able to drill off of existing Cardium pads, and so which will further improve our capital efficiencies. And so it is a important milestone for the company. We've got 2 more wells that are coming online in Open Creek. We anticipate those will be, kind of strong wells. The offsets, one is Highwood, one is Tourmaline, are very, very strong. So we're excited about the play. And, it's yet another reason as to why, we believe the stock's undervalued. I mean, looking at it very simplistically, wells probably cost $5.5 million. If you double that up, you're looking at returns that are very, directly consistent with some of the Duvernay results that, have, quite excited the market.
Yeah.
You look at Spartan, you look at the follow through, that journey is kind of seen on the backs of Spartan's results, given that Spartan operates that JV. They're just equally as strong. Now, is Duvernay a bigger play? Yes. But, if we feel we have 100 plus locations, for a company of our size, for the size of Williston Green, that's material.
A few questions from ABS's burner account, who may be your biggest fan on X, and also helped connect us. So shout out to him. His questions were on OPEC volatility, widening differentials, and hedging. What's your framework on this? How do you balance protecting free cash flow with also keeping torque to higher oil prices?
Yeah, listen, it's a tough answer, right? Because I think it's fair to say that it's a tough question, I should say. Some companies are systematic. Sort of the larger companies tend to be systematic, given they're just more process driven. It's less the case at Obsidian, and at Obsidian it's a little bit more art than it is science. So there's instances, say, I alluded to natural gas earlier. We had a structural thesis that we were bearish, and so we got very aggressive over the last couple of years and hedging natural gas at kind of appropriate times, and that paid off. As relates to oil, don't see a lot of risk in differential over the next 12 months. Diffs have been tight on the heavy side, which has been a bit of a tailwind. I don't think that abates. If you look at Venezuela, Mexico, those countries have been in structural decline, and those have been the barrels that have historically competed with Canadian heavy crude. And so because both the barrels in demand, coupled with the fact that kind of the Canadian takeaway picture is healthy right now, think that diffs will continue to be strong. So don't really see a reason to aggressively hedge those. We would at certain prices, but I'm not worried about a downside scenario. I think oil at $60, it's kind of a little bit of no man's land. I don't think that's a great price to hedge unless you kind of are truly bearish and you think that you're going to see $50 sustained. That's not kind of our house view. If that's your house view, then you should be hedging aggressively and cutting capital and waiting for sunnier skies. Now, can it flush down from here, kind of into the mid 50s for a period of time? It can. It very well may, right? I mean, we're entering the part of the year where holidays are upon us and liquidity, tends to be a little bit, kind of lighter. But against that backdrop, we are very well hedged for Q4. And I'd say to you that if there ever was a time where you'd want to see it flush down, let it be now. But, I think, kind of upside downside, from there is somewhat balanced as to the direction of the next couple dollars, right? I mean, position is already fairly negative. This perceived oil glut's already kind of a consensus view. I don't think that President Trump is inclined to put more pressure on the industry sub 60. He recognizes that there's an equilibrium price. Now, his equilibrium price may be lower than mine, but I think he recognizes that he's got a big constituency that has historically been supportive of him that, kind of in the US that does not want to see sub $60 oil. I think at times it's forgotten or it's glossed over just how important of an economic driver kind of oil production is. If you think about, all the sand, all the chemicals, all the, pumps, valves, casing that goes into cement, that goes into, oil and gas production, it is a big and material driver of economic activity. So you do reach the point of diminished returns where if you, kind of hurt the industry, not only will it just bounce back harder, it might be painful for a period of time, but it'll cause higher prices kind of in the rebound. But, you are potentially creating a headwind for, kind of for jobs and, potentially alienating some of your larger donors. And so, at $60, you're kind of in no man's land, and I don't think we'd look to aggressively hedge on any type of, basis where you kind of locked it in for multiple quarters. I mean, maybe we do it in the short term, but it's not something that we'd want to aggressively roll out.
Second question from Chrome ABS was, how does Obsidian close the gap between your net asset value and some of your other peers? We've talked about a little bit between the buyback and some great assets you have, but any thoughts on what you're doing?
Yeah, I mean, listen, I would say directionally it's more the same, with a caveat. I actually don't think that a buyback, will ultimately close the gap. If you think about, why is that Obsidian trades at a discount, to fair value or to peers, there's probably a couple of reasons for that. I mean, is it the PennWest history? Is it, there was a perception that we had a lot of ARO, which we've since remedied, kind of by selling Pemina, but, perceptions take time to fade. And the problem with the buyback is all you're really doing is just doubling down. I mean, you're capturing shares at a discount, but you're not doing anything from an operational perspective to, kind of change the perception of your assets, right? And so I think what will ultimately happen, the way the discount will ultimately abate is, we'll buy back stock until it no longer makes sense to buy back stock. And at some point we will toggle to resuming the growth plan, right? And then at that juncture, you're just going to have a lot less shares outstanding and will be significantly, kind of more convex to, higher prices and higher production levels. And so that's kind of, I think, the sequencing unfolds. I mean, the act of buying back stock, it probably supports the stock. I'm not sure that it kind of does much to change the perception of why, kind of you're, kind of undervalued to begin with, right?
Good assets too.
Well, we have good assets, right? You just need to be able to ultimately show the market that you have good assets. I mean, if you kind of take a step back and you think about what's transpired at Obsidian, we run the company a little differently, right? When I say we run it a little differently, I think we're a little bit more dynamic in regards to, kind of how we make decisions, right? We rolled out a growth plan in September of 2023 to take production to 50,000 BOEs. And along the way, we kind of slowed it down in part because the shares were trading cheaper and it made more sense to buy our shares than it was to grow production. We then turn around, we sell Pembina, and so you knock down, you basically, as a result of that, you basically pulled your $50,000 BOE production goal. Right now, does that mean we're any less bullish on, kind of our growth prospects? No, right? It just means that was the appropriate decision to make. And so the one advantage you have in being public, because I don't think there's that many right here, right now, because we would never issue our shares at these values, is, your ability to allocate capital, right? And so the shares trade cheaply, you can buy them back, right? Where a private company can't necessarily do that very easily. You got to buy out LPs, and that's a private negotiated deal. That's hard to do. We can just buy shares back. And so, we've had some fits and starts, which if someone wants to be cynical, they can take a cynical view, which is to say, well, they stopped, they slowed down their production program, their production or their growth kind of program
Trajectory.
because the assets aren't as good. Well, no, that's bullshit. Our assets are every bit as good as we thought they are. We just saw an opportunity to make a superior economic decision in the short term. And so it takes time, sometimes for, kind of the cream to kind of float to the top, right? But, we're very happy with kind of where we are. The company's never had, this type of financial flexibility. It's never been in a position where it's effectively shed all of its legacy, kind of issues. And, we're quite excited about, what the next 12 to 18 months will bring.
Yeah. You can't argue with low debt levels. And you own a ton of shares of Obsidian. So you're skin the game.
Certainly have skin in the game.
You got options. And that's the whole point of paying down debt. So
yeah, no, options are generally a good thing. And so, we're happy that we have, many options.
And federal government that seems to be helping out a little bit more now, or at least not getting in the way, which you talked about already, but you view it as maybe more constructive.
Oh, it's undoubtedly more constructive, right? And if they could start to follow through on some of the things that they've outlined, some of the projects they've outlined, some of the initiatives, then I think the market will increasingly become much more comfortable. They don't need to do everything, right? I think the bar was low.
Yeah.
And if they can just kind of step over the bar and just have a federal government that recognizes, kind of the, how vast Canada's resource base is and actually is inclined to help industry, in a thoughtful and sensible way, kind of, produce it and grow it. As I said earlier, capital typically flows to those who treat it best, right? And so there's no doubt that Canada has the resource. Some of the legacy issues like takeaway are now kind of a bit in the rearview mirror. And, if the federal government is also, constructive and conducive, I think multiples will re-rate, and they're starting to already.
It's October 30th, fall of 2025, as we head towards the end of the year. What message would you leave for shareholders?
Yeah, no, listen, the message has been, this has been a atypical year, just given, a sizable disposition and, the volatility kind of in the macros. And, that's created, some uncertainty. But I think the takeaway is, we're as bullish as we've ever been on our opportunity set. I've never been in as constructive a position from a financial flexibility perspective. And, we might be kind of in the eye of the storm right now in regards to volatility, but, kind of on the commodity side, but, quite constructive as we enter the second half of the year and of 26, that is. And so, now is the right time to be thoughtful as to, adding exposure to commodity names in a thoughtful manner, and you can leg in, right? I don't think the opportunity is going to run away from you, but you typically want to buy them when they hate them and sell them when they love them, right? And so, that would be kind of my takeaway.
I really appreciate your time today.
Always a pleasure. Thanks for the invite.
We'll come back again maybe in a year.
I'd love to do it.
All right, we'll leave it there. Thank you very much.
Thank you.